A limited company, unlike other forms of legal business structures, is a separate legal entity. The shareholders or owners of a limited company enjoy limited liability, which means that they do not stand to lose more than the sum invested in the company in the event of a bankruptcy or liquidation. If the company is declared insolvent, it is the creditors who may lose, as they can only be paid to the extent of the issued capital of the business. If they are owed more than that sum, they risk not being paid. In a limited company, ownership and management are divorced. In that, shareholders are not entitled to help manage the company. It is the directors that manage the company for them. Hence, the two important characteristics of a limited company are highlighted in blue, and they are limited liability and separation of ownership and management. What are the advantages and disadvantages of converting a partnership to a limited company? The advantages of doing so are the disadvantages of a partnership, and they are: partners usually have unlimited liability. In a company, they will have limited liability. Profits need to be shared with other partners. There is a possibility of disputes between the partners. Decisions made by one partner are legally binding on the others. The partnership will need to be dissolved if a partner dies. Disadvantages of a limited company, and they are: potential loss of control as additional shareholders invest. There will be costs associated with setting up the company. Legally, more detailed financial information is required of a company, and all the accounts of a company are made available for public scrutiny. A dividend is defined as the share of profits that is distributed to each shareholder. Dividends are paid out of distributable profits. Dividends are expressed either as cents per share or as a percentage of the nominal value of the shares. An interim dividend may be paid to shareholders during a company's financial year if the directors feel that the profits and cash resources are sufficient for the purpose. These dividends are debited in the company's income statement for the year to which they relate. Final dividends are proposed by the directors of the company, but must be approved by the shareholders at the annual general meeting, or AGM, before they can be paid. They are paid after the end of the financial year. Hence, they are not recorded in the year-end financial statements, but are shown as a note. In this slide, we will examine the differences between ordinary shares and preference shares. Let's look at ordinary shares first. Ordinary shares form what is known as the equity of a company. Ordinary shareholders are entitled to vote at annual general meetings, or AGMs. They are, however, paid dividend out of the remaining profit left after the dividend of the preference shareholders has been paid. All the reserves also go up to make up the ordinary shareholders' funds and belong to ordinary shareholders. When a company is wound up, the assets remaining after all the creditors, debenture holders, and preference shareholders are paid belong to the ordinary shareholders. Hence, the ordinary shareholders may receive more or less than their original investment in the company. Let's look at preference shares. Preference shares entitle their holders to certain rights, which ordinary shareholders do not enjoy. Preference shareholders receive a dividend at a fixed rate, which is expressed as a percentage of the nominal value of the share. This percentage is mentioned when the share is described. These dividends are paid before the ordinary shareholders get paid their dividend. In the event of a company being wound up, preference shareholders are entitled to have their capital repaid before ordinary shareholders receive their capital. The different types of preference shares are cumulative preference shares, non-cumulative preference shares, redeemable preference shares, non-redeemable preference shares, secured preference shares, non-secured preference shares, and participating preference shares. The difference between cumulative and non-cumulative preference shares are: cumulative preference shares are entitled to have areas of their dividend carried forward in the event of there being insufficient profit in the current year. Non-cumulative preference shares, however, are not entitled to have any areas of dividend carried forward to future years if the profit of the current year is insufficient to pay their dividend. The other types of preference shares are beyond the scope of this syllabus. In this slide, we examine the differences between liabilities, provisions, and reserves. Liabilities are defined as that which the company owes. They are determined with substantial accuracy. They are created by carrying down credit balances on personal or expense accounts. Provisions are created by the company to provide for liabilities that are known to exist but cannot be determined with substantial accuracy. They are created by debiting the approximate amount of the known liability to the income statement and crediting it to the provision accounts. For example, provision for depreciation of non-current assets. Reserves are amounts set aside apart from the ones mentioned above. They are an appropriation of profits and are created by debiting the appropriation account and crediting the reserve accounts. They may also be created by premiums paid on ordinary shares or preference shares, or by revaluing non-current assets. In this slide, we will be examining the difference between the two reserves, revenue reserves and capital reserves. Revenue reserves are created by transferring profit from the appropriation section of the income statement to the reserve. Hence, the creation of such reserves, usually termed a general reserve, reduces the amount of profit available to pay dividends to shareholders. If revenue reserves are created for a specific purpose, such as a replacement of a non-current asset or for the planned expansion of the business, then they are named accordingly. However, if they are just retained profits to strengthen the financial position of the company, then they are known as general reserves. Retained profit is also a revenue reserve. Capital reserves, on the other hand, are not normally created by transferring profit from the income statement. They generally represent gains that have not been realized. Capital reserves may never be credited back to the income statement and can never be used to pay cash dividends. The following are the more common types of capital reserves: the share premium account, a capital redemption reserve, and a revaluation reserve. In this slide, we will examine the difference between bonus shares and rights issue. So what are bonus shares? When a company capitalizes or converts its reserves by using them to issue shares to ordinary shareholders as fully paid-up shares, these shares are called bonus shares. These shares are so called as the shareholders do not have to pay for them. It is important to note the following. First, as any of the reserves, capital or revenue, could be used to issue bonus shares, directors prefer to use capital reserves and leave the revenue reserves intact because revenue reserves are more flexible than capital reserves. Secondly, no money is received by the business when bonus shares are issued. What is a rights issue? This is an issue of shares made to the existing shareholders of the company. The offer price is generally below market price. What are the advantages of a rights issue? Firstly, the company can raise more capital. Secondly, a rights issue is shorter and a cheaper procedure than a fresh issue of shares. Thirdly, shareholders are rewarded for their loyalty, as rights issues are generally made at a price that is cheaper than the market price. If shareholders do not wish to subscribe to a rights issue, they can sell their rights. It is important to note that with a rights issue, the company receives cash. Let us look at a question about bonus shares. A company has the following capital and reserves: ordinary share capital of $1 each, share premium account, revaluation reserve, general reserve, and retained earnings, totaling $970,000. If the company plans to make a bonus issue of 1 share for every 4 held, what will be the maximum amount of distributable reserves for the company after the bonus issue? Let us do our workup. The number of bonus shares issued is equal to 1/4 times 400,000, which is equal to 100,000. As there are enough capital reserves to cover this amount, $60,000 share premium account and $120,000 revaluation reserve, the revenue reserves are not to be touched. These revenue reserves are also known as distributable reserves: 300,000 general reserve and 90,000 retained earnings, to give you a total of $390,000. Hence, the answer is $390,000 will be the maximum amount of distributable reserves for the company after the bonus issue. In this slide, we will be examining the creation of the share premium account, which is a capital reserve. P Limited prepares financial statements to 31st May. The following transactions, all of which were entered in the appropriate accounts in the ledger, occurred in relation to ordinary shares. On the 1st of June 2015, 100,000 ordinary shares with a nominal value or a par value of $1 each were issued at a price of $1.45 each. Of this, $1.15 was received, which included the full par value. On the 30th of September 2015, the balance outstanding was received in full. Note, there was a first call on June 1st and a second call on September 30th. Monies received at the first call are always allocated to the share capital first and then the share premium account. Let us now look at the journal entries made to record the issue of these ordinary shares at a premium. On the 1st of June 2015, The bank account was debited $100,000 and ordinary share capital was credited $100,000. This is the face value or nominal value of the shares issued. On the same day, the bank account was debited $15,000 and the share premium account was credited $15,000. This is the share premium that was received on the shares that were issued on the 1st of June. On the 30th of September 2015, when the remaining money was received, the bank account is debited by $30,000 and the share premium account is credited with $30,000. Continuing on from the example in the previous slide, the same company, P Limited, on the 1st of October 2016, made a 1-for-4 rights issue at a discount of 15% of the most recent share valuation of $1.40 per ordinary share. All shareholders took up their rights in full. A 1-for-4 issue works out to 1/4 of 100,000 shares, which is equal to 25,000 shares that were issued at the rights issue stage. The journal entries to record the issue of ordinary shares at a discount are: bank account debited $25,000, which is 25,000 shares times $1, the face value of a share. Ordinary share capital credited $25,000. Bank account debited $4,750 and share premium account credited $4,750. Let's look at the working for the share premium. A discount of 15% works out to $1.19 per share. The share premium per share is therefore $1.19 minus the face value of $1, which gives you a premium of 19 cents per share. The total share premium is therefore 19 cents times 25,000 shares that were issued at the rights issue stage, which is equal to $4,750. This example is about creating a revaluation reserve, which is a capital reserve. The exhibit is taken from my book, Revising AS Accounting, a study guide. Let's look at the exhibit. An extract from Malini Limited Statement of Financial Position is as follows: premises at cost $50,000, provision for depreciation $12,000, this is accumulated depreciation, to give you a net book value of $38,000. The premises have been professionally revalued at $80,000. A decision has been made to revalue the premises in the books of the company. Companies should revalue their non-current assets that may have appreciated from time to time to reflect their true value or market value. This is to ensure that their statement of financial position reflects a robust, true and fair view of their assets to prevent easy takeovers. The journal entry to record the revaluation is as follows: premises at cost $30,000. This is the difference between the market value $80,000 and historic cost $50,000. This is debited. Provision for depreciation $12,000 debited. This is to eliminate the accumulated depreciation. Premises revaluation reserve is therefore $42,000, which is $30,000 plus $12,000. This is a great example taken from a past paper on the issue of shares. F Limited is a large retail company. On February 1st, 2016, the company invited applications for 50,000 ordinary shares of $1 each at an issue price of $1.20. The following terms applied. payable on application 50 cents, payable on allotment 70 cents. Applications were received for 65,000 shares. All monies received in respect of the share issue were posted to the bank account and a share issue holding account until the shares were allotted. At the time of allotment, transfers were made to the share capital account and the share premium account, and monies were returned to unsuccessful candidates. Let's look at the working. Amount received on application was $32,500. This amount was debited in the bank account and credited in the share issue holding account. Amount received on allotment in the blue box was $35,000. This amount was debited in the bank account and credited in the share issue holding account. Amount returned to unsuccessful applicants in the pink box was $7,500. This amount is credited in the bank account as the amount was returned and debited in the share issue holding account. Amount transferred to share capital account was $50,000 in the green box. This amount was debited in the share issue holding account and credited in the share capital account. Amount transferred to share premium account was $10,000 in the light blue box. This amount was debited in the share issue holding account, which is now closed, and credited in the share premium account. In this slide, we will look at what a debenture is. A debenture represents a loan taken by the company from many debenture holders. A document called a debenture states the amount of the loan and the interest payable. It also includes the dates on which the loan is to be repaid by the company. Repayment is spread over a period, and the dates of the start and the end of the period are also included in the document. Debenture holders are not members of the company and cannot vote at annual general meetings or AGMs. A debenture is listed as a long-term liability in the statement of financial position and not under the share capital or reserves. If the debenture is due for redemption within 1 year, then it is shown as a current liability. Debenture holders are repaid before the shareholders of the company in the event of the company being wound up. Interest on debentures must be paid even if the company has not made a profit, and this interest is debited as an expense in the income statement. Note, debentures are included as a deduction when calculating net assets. Let us examine what is better: raising additional finance through a rights issue or through debentures. Points in favor of a rights issue. A rights issue does not dilute ownership. A rights issue is attractive to shareholders who see it as a reward for remaining loyal to a company. A rights issue may be less expensive than issuing debentures. A rights issue contributes to permanent capital. Now let us look at the points against a right issue. If there has been a recent rights issue, shareholders may not want another one. A rights issue may result in a fall in the share price on the share market. Payment of dividends is discretionary and may not be forthcoming. Let us look at points in favor of issuing debentures. Debentures do not affect ownership. No voting rights are available to debenture holders. Points against debentures. Debentures increase debt. The lender may require security. Regular payments of interest and capital increase expenses and thus dilute profit for the year. And debentures need to be repaid. The following exhibit is adapted from past paper and will show how an income statement and the statement of changes in equity is to be drawn up for a limited company. Pause the video in order to study the information given. Additional information available. 1. Administration expenses includes a payment of $9,000 for insurance for the 3 months ended 30th of November 2018. As the financial year of KA Limited ended at 30th of September 2018, administration expenses have been prepaid for 2 months, October and November. 2. Carriage inwards $3,000 has been included in distribution costs. Carriage inwards increases the cost of sales and therefore will have to be added to the cost of sales and subtracted from distribution costs. 3. Land and buildings includes land at a cost of $260,000. We will have to subtract $260,000 from the land and buildings cost of $980,000 in order to calculate provision for depreciation on buildings at 2.5% per annum. 4. The company's depreciation policy is as follows: 20% per annum using the reducing balance method to provide for depreciation of equipment. That will work out to 20% of 90,000 minus 30,000. Buildings, 2.5% per annum using the straight line method. That would be 2.5% of $980,000 minus $260,000. The solutions are in the following 2 slides. Here is the income statement for KA Limited for the year ended 30th of September 2012. Let us first look at the working. Working 1. The cost of sales is equal to $587,000 as per the trial balance plus carriage inwards of $3,000 as discussed in the last slide, which gives you a total of $590,000. Working 2. Distribution costs. The amount as per trial balance was $46,000, from which we deduct carriage inwards $3,000 as discussed in the last slide, and add provision for depreciation of equipment $12,000, which is equal to 20% of $90,000 minus $30,000. This gives us a total of $55,000 for distribution costs. Working 3. Administration expenses. The figure as per trial balance was $42,000, from which we deduct insurance prepaid. That was for 2 months out of 3 months times $9,000, which works out to 2/3 of $9,000, which is equal to $6,000. Depreciation for buildings at 2.5% using the straight line method, which is equal to $980,000, which was the cost of land and buildings, minus the cost of land $260,000, which gives you a provision for depreciation for the year of buildings only of $18,000. Therefore, administration expenses now work out to $54,000. Working 4. Finance costs. This is the interest that has been paid on debentures. 8% of $75,000 works out to $6,000. Now let us look at the income statement on the left of the slide. Revenue $936,000 minus cost of sales $590,000. That gives you a gross profit of $346,000, from which administration expenses $54,000 as per working tree and distribution expenses $55,000 as per working two are subtracted to give us a profit from operations of $237. Finance costs as per working four are now subtracted $6,000 to give us profit for the year $231,000. The statement of changes in equity is on the next slide. This continues from the previous two slides. Additional information. During the year ended 30th September 2018, the directors of KA Limited had made a rights issue of 1 ordinary share for every 2 shares held at a price of 70 cents per share. The issue was fully subscribed and had been recorded in the books of account. Let us look at our working first. Working 1. Rights issue and opening balances. Rights issue 1 for 2, leading to a share capital of 450,000. Therefore, the issue was 1/3 of 450,000, which is equal to $150,000. Share premium 20 cents on each 50 cents share would be equal to 2/5 of $150,000, which is equal to $60,000. Therefore, the opening share capital was $450,000 minus $150,000, which is equal to $300,000. The opening share premium account was $90,000 minus $60,000, which is equal to $30,000. Let us now go to the statement of changes in equity for the year ended 30th September 2018. The opening balances were as per working 1, share capital $300,000, share premium account $30,000. Retained earnings as per the trial balance was $106,000 to give you a total of $436,000. Rights issue as per working 1, share capital $150,000, share premium $60,000 to give you a total of $210,000. Dividends paid as per the trial balance $60,000. Profit for the year as per the income statement drawn up in the last slide $231,000. Therefore, the balances at 30th September 2018 were share capital $450,000, share premium account $90,000, retained earnings $277,000, and a grand total of $817,000. In this question, taken from a past paper, we will be examining the drawing up of the statement of financial position for a limited company. The directors of M Limited have a policy of not paying interim dividends. The statement of changes in equity of the company for the year ended 31st December 2016 was as follows. Take a minute to pause the video and study the statement of changes in equity. You will realize that on February 10th, a bonus issue of shares was made and the share premium account was used to the tune of $100,000. The closing balances for the year ended 31st December 2016 were ordinary share capital $500,000, share premium account $50,000, general reserve $50,000, retained earnings $100,000 to give you a grand total of $700,000. You are given the following information. At 1st January 2017, the 10% bank loan, which is due to be paid in 2025, was $100,000. The interest on this loan has obviously accrued to the tune of $10,000, and that will be subtracted from retained earnings this year. During the year ended 31st September 2017 again, dividend was paid $66,000. This will be subtracted from retained earnings as well. Profit for the year before loan interest was $113,900. That will be added to retained earnings. There was no change to issued share capital. At 31st December 2017, the non-current assets at net book value, which included property, plant and equipment, were $931,900. Current assets were $290,300. Current liabilities, including accrued loan interest, were $96,300. A revaluation reserve was created to the tune of $288,000. With this information, let us now draw up the statement of financial position as at 31st December 2017. Before we do that, let us look at the working. Retained earnings is now equal to $100,000, which was the closing balance from last year, plus $113,900 profit for this year, minus $66,000 dividends paid, minus $10,000 accrued loan interest, to give you a new figure for retained earnings of $137,900. Let us start with assets, non-current assets, which included property, plant, and equipment, $931,900. The current assets were $290,300 to give us a total assets figure of $1,222,200. The second half of the statement of financial position is equity and liabilities, of which equity consisted of ordinary share capital $500,000, share premium account $50,000. Both of these did not change during the year. General reserve $50,000, which did not change as well. Revaluation reserve $288,000. This was newly created. Retained earnings $137,900 as per the working below. Non-current liabilities, 10% bank loan due in 2025, $100,000. Current liabilities, $96,300, to give you a total of equity and liabilities amounting to $1,222,200, which equals the total assets figure. And that is our statement of financial position as at 31st December 2017. This exhibit is taken from my book, Revising AS Accounting, a Study Guide. Let us look at the journal entries passed when a debenture is redeemed. When a debenture is redeemed or repaid, the following entries are passed. A. If the debenture is redeemed at par, that is, not at a premium, the debenture account is debited and bank account credited with the amount. B. If a debenture is redeemed at a premium, the debenture account is debited and the share premium account, or retained earnings if there is no share premium account, is debited and bank account credited with the amount. This is an interesting example adapted from a past paper. The shareholders of a company with 125,000 shares of $1 each, have not received any dividend since the company was formed. However, the financial statements show the following. Profit for the year ended 31st May 2016 was $15,000. Profit for the year ended 31st May 2017 was $30,000. Cash and cash equivalents at 31st May 2017 were $90,000. On the 1st of June 2017, several major shareholders demanded that the directors pay a dividend of 48 cents per share. You are to advise the directors on how they should respond to the shareholders' demand and support your answer with calculations. Let us make those calculations first. The shareholders' demand would result in a payment of $125,000 times 48 cents, which is equal to $60,000. The retained earnings are only $45,000, that is $15,000 from the year ended 31st May 2016 and $30,000 from the year ended 31st May 2017. Though there is enough cash in the bank of $90,000 to pay this dividend, the retained earnings are not enough. Therefore, a dividend of 48 cents per share is not advisable. The maximum dividend payable would be 45,000 divided by 125,000, that's the number of shares, which is equal to 36 cents per share. Even if this maximum payable dividend of 36 cents were paid, there would be fewer funds, that is 90,000 minus 45,000, which will be paid out as dividend, to just give a remainder of 45,000 available for the future. This is not advisable. More information about AS Accounting, a Study Guide. The content of this book matches the latest CRE AS syllabus and is pitched at a level that is extremely workable. The book is written by a qualified and experienced teacher and fills the need for a guide that is solely meant for the CRE AS accounting course. Some salient features of the book are: it unpacks the CRE AS accounting syllabus, IAS terminology has been used, students love the unique question and answer presentation of theory, there are numerous tips for success, and exhaustive exercises for practice. This book is available at most book outlets worldwide, including Book Depository and Amazon. They are available in hard copy as well as in e-book format. Here are other titles available: AS Accounting Workbook, a write-in workbook that will help you prepare for your examinations, and Revising A-Level Accounting. Please contact me at junebaptista@hotmail.com for more information and for answers.